This is our 1 hour chart. So actually you can see that this is our 1 hour chart, and this is that odd low that were marked on a weekly chart, and it has been transposed into the 1 hour chart. And this is that fair value gap that we marked on a daily, and it has been transposed also in the 1 hour chart. Now in the 1 hour chart, we are going to mark the Friday's close, which can also stand as the Monday's trading. So this is the Friday's close, and we can put it as Monday's trading, as the start of Monday's trading. And we'll go into the previous week and mark the Friday's close also. Here we are, and we can mark this as Friday's close. We can mark it as Friday's trading, and this is Monday's trading. So here we are on Monday. The price action went to fill this fair value gap, which formed in a daily chart, and it has also been transposed into a 1 hour chart. Now on this Monday, price went and swept the liquidity, which was from the other week, which was formed on Sunday, so which was formed on Friday, I mean. So here we have got this liquidity, so we can mark this as a buy side liquidity. And also we see here on this is on Monday, price formed this high of the week, and it started dropping, and here on Tuesday, price went to sweep the short-term low which formed on Monday. So we're gonna mark this short-term low which formed on Monday. Let's zoom it a bit so that we can see. All right, so this is that short-term low. We are saying that it was formed on Monday, and this is the high that formed on Tuesday. So we are going to take that trend line again and mark this odd low. So you can see that it's a small move above the odd low. It's a small move above the odd low, but still it is what? It is a sweep on liquidity. So we're gonna mark that. We're gonna mark this as buy side liquidity. This is buy side liquidity, which was formed on a 1 hour time frame. Now we are going to drop into a 15-minute time frame. This is our 15-minute time frame. I've dropped into the 15-minute time frame, and we'll see that this is the odd row that was formed. This is the odd row that was formed on Monday, and price went and sweep that liquidity there. So by zooming it in, we're gonna be able to see clearly what happened on that day. We are going to see what happened on that day. So this one has been swept on, that's on a daily. Let's mark the Tuesday's trading day and see. Yes, so this is where the Tuesday's trading has started. This is the midnight candle of Tuesday. This is the midnight candle of the Tuesday. Then this is Tuesday. Price has been going a little high, and it consolidated here, and it went to sweep this liquidity here. So you can also see that on Tuesday, this candle swept this liquidity here also. This candle went to sweep this liquidity. So we can mark this as a sell side liquidity. So I can mark this as a sell side liquidity. Of course, it's a small one, but still it is a sell side liquidity. So you can see that on Tuesday, the candle went straight ahead to land this liquidity, that short-term old high. Now we are going to drop into the 5-minute time frame. We are going to drop into the 5-minute time frame to look for a shift in market structure, as we have seen in the 15-minute time frame that the liquidity has been landing to. Now we are going to look for a shift in market structure. And here we are. This is on that Tuesday. We can see that there is this odd low. There's this odd low formed before the market swept this liquidity. And there's another odd low here also, which was formed before the market swept the liquidity. So here we can mark this one as a all right. So market structure shift. We can mark this one as a market structure shift. Others also refer to it as a break in market structure, because the structure has been broken. This structure has been broken here, but still we are marking it as a shift in market structure, because ICT in episode number 2 he mentioned that a shift in a market structure is a break in market structure on a short line, while a break in the market structure is a break on the market structure on a long run. For example, on a daily, if the structure is broken, has been broken in a daily, it means that that's a break in the market structure, because the price is gonna move like big time. While when the structure has been broken in a small time frame, this is referred to as a market structure shift, or a shift in market structure. So let's put this at the light of the line, and now we are going to drop into a 3-minute time frame. So you can see that the price swept this liquidity here. This is that high that we marked on our 15-minute time frame, and dropping into the 3-minute time frame, it has been transposed, and here is a break in market structure, and this is another break in market structure. So by marking this break of market structure, we are going to mark this as a fair value gap. So a fair value gap is a free candle pattern. There is this candle here, and this candle which has been given some space here. This gap between these two candles, this is a fair value gap. So this is the bearish fair value gap. So let's give it this color, and let's light something like 3-minute fair value gap. We can also continue to say this is our what? Entry. We can say that this is our entry. So once the price has broken this structure here, we go into the price leg that broke the market structure to look for a gap, which is a fair value gap, this gap which has formed here. And once price has reached this fair value gap, it's when we take our entry. Once the price has reached this fair value gap, we can take our sales here. We will sell here and put our stop loss above this low. So let's mark this low as our stop loss. So this is our stop loss, and for our target, we are going to look for an odd low which has formed. It can either be the odd low of that trading day or else an odd low of a previous trading day. So we are going to mark this odd low of that particular trading day. This is Tuesday, and we are marking this odd low that formed on Tuesday as our target. As ICT mentioned in the staging, that we should look for low-hanging fruits. These are the targets that can easily be hit. So as we are learning, let's try to look for those low-hanging fruits, and I'll mark this as my take profit. Then I'll mark it okay. This is my take profit. And we can see that this was our entry, this fair value gap, which formed on a price tag that broke the structure here. Once the structure was broken, we were looking for a fair value gap in a price tag that caused a break in market structure, and then price came and retest that fair value gap. Once it reached on that fair value gap, we were taking our entry here, a sell, and then this was our first target, which was the odd low that formed on Tuesday, and the trade was also taken on Tuesday. So before I forget, one thing that I see also mentioned was about time. The time that we are going to expect the trade setups, the time that we are also going to execute our trade setups. So he said that we should hunt for this setup between 8:30 to 11 a.m., which is the New York time. So in order to be in line with what ICT said, we had to set our time here, which is UTC, New York local time. So we can see that the setup was also formed between that time. This was 8:30, around 8:30. It's when this candle which formed at 8:33 was the candle that formed that fair value gap that market went and tested. So we can see that the candle that first hit the fair value gap was the candle that formed at 9:42, which is the time that ICT mentioned that the setup should form and the entry should be taken. So without saying much, this is what I've learned from the ICT 2022 mentorship episode 1 to 3. So yeah, this is it, guys. Be there as I will continue sharing with you my journey while learning the ICT 2022 mentorship, and hopefully I'll be posting my videos every week. That is, I'll be posting 1 to 2 videos a week. And if you haven't subscribed to my channel yet, please hit that subscription button and don't forget to hit that notification bell so that whenever I post another video, it should notify you. Thank you, guys.